What I'm about to share with you demands your full attention. Not because I'm asking for it, but because what happened in the silver market between Sunday night and Monday morning represents one of the most blatant examples of institutional market manipulation we've witnessed in over a decade. If you hold silver positions, if you're considering entering the market, or if you simply want to understand how modern financial markets truly operate when retail investors threaten institutional control, you need to understand what transpired in the last 48 hours. It's Tuesday, January 13th, 2026. Yesterday, silver shattered the $85 per ounce barrier for the first time in modern trading history. The Shanghai Futures Exchange pushed even higher, touching $93 and sending shockwaves through global commodity markets. For weeks, we'd been discussing the death of arbitrage, the accelerating collapse of the paper market's credibility, and how physical market dynamics were finally asserting dominance over derivative pricing mechanisms. The excitement across trading communities was palpable. Momentum was building. The squeeze everyone had been anticipating for years appeared to be materializing. Then, while most of North America slept, the Chicago Mercantile Exchange executed a strategic intervention. They issued a margin notice, effective immediately, announcing significant changes to the collateral requirements for silver futures contracts. This wasn't a routine adjustment. This wasn't a measured response to ordinary volatility. This was a precisely calculated move designed to accomplish one objective: force the liquidation of retail positions and protect the large financial institutions holding massive short positions that were hemorrhaging billions of dollars. This isn't speculation. This isn't conspiracy theory wrapped in paranoia. This is documented fact, supported by publicly available data, historical precedent, and the exchange's own notices. I'm going to walk you through exactly what happened, why it happened, how it connects to larger economic patterns that have proven predictive with 100% historical accuracy, and what it means for anyone holding or considering positions in precious metals. What you're about to hear will sound like the plot of a financial thriller, the kind of market manipulation that seems too brazen to be real. But it is real. It happened overnight, and it's unfolding right now as markets digest the implications. If you don't understand this moment, if you react emotionally to short-term price movements without grasping the mechanism behind them, you risk making the single worst investment decision of your life. You risk selling your position just before the largest wealth transfer in precious metals history. So, let me break down exactly how the system works, how it's being manipulated, and why this moment of manufactured pressure is actually confirmation that we're approaching something extraordinary. Here's what the CME did. On January 12th, they issued a margin notice outlining a fundamental change in how collateral requirements are calculated for silver futures contracts. For those unfamiliar with futures mechanics, margin requirements function as a security deposit. When you purchase a futures contract, you don't pay the full notional value up front. You deposit a fraction of that value as margin, which serves as collateral against potential losses. This is what creates leverage in futures markets. One silver futures contract controls 5,000 ounces of silver. At $85 per ounce, that contract represents $425,000 in notional value. Under the previous margin regime, you needed approximately $32,500 to control that position. This is the power of futures leverage. With $32,500, you're controlling $425,000 worth of silver, a leverage ratio of roughly 13-1. This leverage is precisely what allows retail traders to compete with institutional players. It's what enables individuals with mid-sized capital bases to take meaningful positions in commodities markets. But it's also what the large institutions resent, because when retail traders collectively pile into positions demanding physical delivery or riding momentum, it disrupts the carefully managed paper market that benefits the banks holding short positions. So the CME changed the rules. Under the previous system, margin requirements were relatively fixed regardless of the underlying commodity's price. Whether silver traded at $50, $70, or $85, the margin requirement remained fairly stable, but the new system implements a percentage-based calculation. Specifically, margins are now set at 9% of the contract's total notional value. Let's calculate what this means. At $85 per ounce, one contract worth $425,000 now requires a margin of $38,250. That's an increase of $5,750 per contract, a 17.7% margin hike implemented overnight without advance warning in the middle of a historic rally. You might think an 18% increase, while inconvenient, isn't catastrophic. But consider the mechanics of how this impacts leveraged traders. If you're a retail trader who has carefully allocated your capital across multiple contracts, using maximum allowable leverage to build a meaningful position, you've just received a margin call. Your broker has notified you that your account no longer meets minimum requirements. You have two options: deposit additional cash immediately to cover the shortfall, or liquidate positions to bring your account back into compliance. Most retail traders don't have tens of thousands of dollars in immediately available liquid capital sitting idle in bank accounts. They've deployed their available capital to build their positions. So when the margin requirement suddenly jumps 18% across all contracts, they can't meet the call. They're forced to sell. Not because their analysis has changed, not because the fundamentals have deteriorated, not because they've lost conviction in their thesis. They're forced to sell because the exchange changed the rules and they don't have the capital to meet the new requirements. Now imagine this happening to thousands of retail traders simultaneously. What happens to price when thousands of contracts hit the market at the same time in forced liquidation? The price crashes. Not because of any fundamental development, not because of a change in supply or demand dynamics, not because new mine production came online or industrial demand collapsed. The price crashes because the exchange altered the rules to manufacture forced selling. This is market manipulation in its purest form. And it's not the first time the CME has deployed this tactic. Let me take you back to January 2011. Silver was experiencing a powerful rally, climbing from $18 per ounce toward $30 over several months. Retail investors were accumulating positions. Momentum was building. Public awareness was growing. Then the CME acted. They raised margin requirements 5 times in 9 days. The margin jumped from $6,000 to $21,000 per contract, a 350% increase in less than 2 weeks. The result was predictable. The price crashed from $30 to $26 almost immediately as leveraged traders were forced out of positions. Thousands of retail investors were liquidated. The rally stalled. But here's what matters. The fundamentals hadn't changed. Silver recovered, and by April 2011, it was approaching $50 per ounce. The underlying supply and demand dynamics that had driven the initial rally remained intact. The margin-induced crash had simply shaken out the leveraged retail positions. Then, as silver approached $50, the CME struck again. More margin hikes, more forced liquidation, and finally, on Sunday night, April 24th, 2011, they delivered the knockout blow. They implemented a massive margin increase while markets were closed, ensuring traders couldn't react in real time. When markets opened Monday morning, silver gapped down violently. The price plunged from $50 to $42 in a single session. The cascade continued over subsequent weeks. Silver fell to $35, then $33, eventually bottoming around $26 by September. That event is known in precious metals circles as Silver Sunday. It wasn't a response to changing fundamentals. It was a strategic manipulation designed to protect institutional short positions and eliminate retail participation. The playbook was simple. Change the rules when retail traders are winning, force liquidation, create panic, and allow institutional players to cover shorts at suppressed prices. Now, in January 2026, we're watching the exact same playbook unfold. Silver breaks $85, Shanghai trades at 93. The squeeze intensifies. Physical market dynamics begin overwhelming paper market pricing. And what does the CME do? They raise margins. They shift to a percentage-based calculation that ensures margins will continue rising as price increases. They force liquidation. They manufacture a sell-off. The strategy is identical. The goal is identical. Protect the banks holding short positions and eliminate retail traders before the real rally begins. But here's what they didn't count on. This time is different. Not because the manipulation won't create short-term volatility. It will. Not because retail traders won't get shaken out. Some will. This time is different because the underlying fundamentals are exponentially more powerful than they were in 2011. In 2011, the silver shortage was primarily an investment-driven phenomenon. Retail demand was high, but industrial demand was manageable. There was no structural supply crisis. The paper market, while stretched, wasn't facing an existential threat. The manipulation worked because they could suppress the price long enough for investment demand to cool and for the narrative to shift. But in 2026, we're facing a completely different landscape. The shortage is real and structural. Industrial demand is surging from electric vehicles, solar panels, 5G infrastructure, and military applications. China has implemented export licensing requirements that have effectively shut off the world's largest source of refined silver. The Shanghai premium has exploded to $14 and climbing, a clear signal that physical markets have decoupled from paper pricing. Mints are reporting delivery delays extending 8 weeks or longer. Dealer premiums remain elevated at $8 to $15 over spot. You can manipulate paper contracts. You can change margin requirements. You can force traders to sell futures positions. But you cannot manipulate physical reality. You cannot force a solar manufacturer to stop needing silver. You cannot convince Tesla to build electric vehicles without it. You cannot print physical silver the way central banks print currency. And you cannot deliver paper contracts to a factory that needs actual metal. The margin manipulation will create short-term volatility. It will shake out some weak hands. It will generate fear and uncertainty. But it will not change the ultimate trajectory, because the physical shortage is real and worsening. While the CME was busy protecting their banking constituents, one of the most respected macro strategists in the institutional space released an analysis that perfectly contextualizes what we're witnessing. His name is Tom Bradshaw, a seasoned professional analyst who works with institutional clients, and he's identified what he calls the 38% signal. Here's how it works. Bradshaw studied every major economic cycle over the past 50 years, looking for reliable leading indicators of severe recessions. What he discovered is a pattern with a 100% success rate across modern financial history. The pattern is this. Whenever gold rises more than 38% in a single calendar year, a severe recession follows within 12 months. Not sometimes, not usually, every single time, no exceptions. This has occurred 3 times in modern history. In 1973, gold rose over 40% from $63 to $97. In 1974, the United States entered one of the worst recessions since the Great Depression. Unemployment soared, GDP contracted sharply, inflation accelerated into double digits. It was an economic nightmare that persisted for years. In 1980, gold rose over 100%, from $512 to $850. In 1981, the United States entered another severe recession. The Federal Reserve raised interest rates above 20% to combat runaway inflation. Unemployment hit nearly 11%. The recession was brutal and prolonged. In 2008, gold rose over 30%, from $833 to $1,087. The recession was already beginning, but it accelerated dramatically. Lehman Brothers collapsed. The financial system nearly imploded. The stock market lost 50% of its value. It became the worst financial crisis since the Great Depression. The pattern is clear. Gold rising more than 38% in a calendar year isn't just a bullish signal for gold, it's a warning siren. It indicates that capital is fleeing traditional assets and seeking safety in hard money because participants no longer trust the financial system's stability. It's a leading indicator that something is fundamentally broken in the economic structure. In 2025, gold rose over 40%, climbing from roughly $3,000 to over $4,600. The signal has triggered. The alarm is ringing. And according to Bradshaw's analysis, which has never been wrong, a severe recession is coming within the next 12 months. But Bradshaw doesn't believe we'll simply slide into recession and stagnate indefinitely. He expects the pattern to mirror 2008. First, a sharp liquidity crunch, where everything sells off simultaneously. Stocks, bonds, commodities, cryptocurrencies, everything crashes because market participants need cash to meet margin calls, cover losses, and service debts. In 2008, gold and silver actually declined during the initial crisis phase. Not because they were poor investments, but because people were forced to sell anything liquid to raise cash. Gold dropped from $1,000 to $730 in weeks. Silver plunged from $21 to $8. It was a violent, indiscriminate liquidation. But then, after the Federal Reserve intervened with massive monetary expansion, trillions in quantitative easing, and emergency lending facilities, gold and silver exploded higher. Gold rallied from $730 to $1,900 over the next 3 years. Silver surged from $8 to $49. The real bull market didn't begin until after the crash. The crash was the final shakeout, the liquidation of weak hands and leveraged positions, before the sustained rally. Bradshaw believes we're about to witness the same pattern. A short-term liquidity crisis, forcing everything lower. Panic across markets. Then massive Federal Reserve intervention, currency debasement, and an explosive rally in hard assets. He has specific price targets for this cycle: $9,000 per ounce for gold, $375 per ounce for silver by 2028. Not $100, not $150, $375 per ounce. That represents over 440% appreciation from current levels. And he's not speculating wildly. He's basing these projections on historical monetary expansion patterns, escalating sovereign debt levels, accelerating industrial demand for silver, and the structural supply deficit that's been building for years. Bradshaw is analyzing the same data. Central banks and sovereign wealth funds are watching, and his conclusion is that the current monetary system is approaching a breaking point. Now, let's connect these dots. The CME just raised margin requirements in the middle of a historic silver rally. Why now? Why when silver just broke $85 and Shanghai is trading at 93? Because they understand what's coming. They recognize that Bradshaw's signal has triggered. They know a recession is approaching. They know that when that recession forces the Federal Reserve to implement another multi-trillion-dollar monetary expansion, gold and silver are going to explode. And here's the critical insight. They also know that if retail traders are still holding long positions when that happens, the banks with massive short positions are finished. Major financial institutions have been selling paper silver for years to suppress prices and profit from the manipulation. But if silver reaches $375, those short positions become catastrophic losses large enough to threaten institutional solvency. So what do? They change the rules now, before the major move begins. They raise margins to force retail liquidation. They create fear, generate selling pressure, and manufacture a pullback. They shake out the weak hands so that when the real rally begins, when silver climbs from 85 to 150 to 250 to 375, retail investors are no longer positioned to benefit. We get stopped out. We get scared out. We sell near the bottom. And the institutions cover their shorts at reasonable prices before the explosion. This is financial warfare, and retail traders are the target. But here's what they're inadvertently revealing. By raising margins, by changing rules mid-rally, they're admitting they're losing control. They're admitting the fundamentals are against them. They're admitting that the only way they can win is by rigging the game. And when your opponent is that desperate, when they have to cheat to survive, that's not the time to fold. That's the time to recognize you're on the right side of the trade. Look at the stark disconnect between paper and physical markets. In the paper market, the CME just raised margin requirements. Leverage is restricted, forced selling is occurring, price is under pressure. Traders are panicking. But in the physical market, nothing has changed. Shanghai is still trading at $93, an $8 premium over COMEX. Dealers across the United States are still charging $8 to $15 premiums for physical coins and bars. Mints are still reporting 8-week delivery delays. The physical shortage is still real. Vaults are still depleted. Industrial demand is still surging. Chinese export restrictions are still in place. None of the fundamental drivers have changed. The only thing that's changed is the rules governing the paper casino. The CME can raise margins to 100% if they choose. They can make futures trading so capital intensive that retail participation becomes impossible. They can effectively shut down retail access to the paper market. But that doesn't create a single ounce of physical silver. It doesn't open a new mine. It doesn't convince China to resume exports. It doesn't reduce demand from Tesla, Apple, or solar manufacturers. All it does is temporarily suppress the paper price while the physical shortage continues worsening. Eventually, the paper price must converge with physical reality. You can't deliver a paper contract. You can't build a smartphone with a futures position. You can't manufacture a Patriot missile with an ETF share. At some point, industrial buyers need actual metal. And when they demand physical delivery and the COMEX cannot provide it, the paper market will collapse. Price will be determined by physical market dynamics. And according to Shanghai, that price is already $93. According to Tom Bradshaw's analysis, it's ultimately heading to $375. Here's what the CME is attempting to accomplish in the immediate term. They're trying to create a sell-off today, this week, to frighten you into a catastrophic decision. They want you to see red on your screen. They want you to watch silver drop from 85 to 82, 80.78. They want panic. They want you to think the rally has ended, the bubble has popped, and you should sell before it collapses back to 50. They want you to forget Shanghai is at 93. They want you to ignore physical premiums. They want you to dismiss the industrial shortage. They want you to disregard Bradshaw's $375 target. They want you focused on a temporary $5 pullback so you'll panic sell your position. Why? Because they need to buy it from you cheap. They need to cover shorts at 80 instead of 150. They need to survive the squeeze that's building. This is the last desperate move of a broken system, the death rattle of a rigged market that knows the game is ending. And if you fall for it, if you sell physical silver because the paper price dropped a few dollars, you will regret it for the rest of your life. Let me be absolutely clear about what makes sense right now. If you own physical silver, coins, bars, rounds, whether stored at home or in allocated storage, do not sell. The paper market is lying. The physical market is telling the truth. And the truth is that silver is genuinely scarce. Demand is accelerating, the system is breaking, and price is heading substantially higher. If you own silver futures and received a margin call this morning, you have a decision to make. If you have additional capital available and can meet the new requirement, deposit it and hold your position. But if you're fully deployed without access to additional capital, close your futures position and use proceeds to purchase physical silver. Exit the paper market where rules change arbitrarily. Enter the physical market where they can't touch you. If you don't own silver yet and have been waiting for the right entry point, this manufactured dip is likely your opportunity. Don't wait for $70. Don't wait for financial media to declare it safe. Don't wait for a financial advisor who probably owns no silver himself to grant permission. Acquire physical silver now. Pay the premium. Accept the delivery delays. Understand you might pay $93 to $95 all in even though spot is $85. Because in 6 months, when spot is $150 and dealers are sold out, you'll wish you had paid $95 today. I'm not providing financial advice. I'm not your advisor. I'm not telling you what to do with your capital. But I am telling you what I see. And what I see is a dying paper market, a physical market screaming shortage, a Federal Reserve trapped by its own policies, a recession signal with 100% historical accuracy, a macro strategist projecting $375 silver, and a futures exchange so desperate to stop the rally that they're changing rules mid-game. Every indicator is pointing the same direction. Every piece of evidence is conveying the same message. The only question is whether you'll listen or whether you'll let fear and manipulation trick you into abandoning the best trade of your lifetime. The choice is yours, but the window is narrowing. The CME just confirmed what we already knew. They're terrified because they're losing control. The physical shortage is real. The recession signal is real. The Shanghai premium is real. Tom Bradshaw's $375 price target is real. Do not let them steal your silver. Do not let them shake you out. The empire is striking back because it's losing. And when your enemy is this desperate, that's when you hold the line. $375 is coming. The timeline is accelerating. The fundamentals are undeniable. Get out of paper. Get into physical. Do it now.